Do you know what it takes to achieve 100 times return on a stock? Is it possible to find such stocks in the market? In this video, we will discuss most important points from the book 100 Baggers to learn how we can identify such companies. Stocks that go from 0 to 100 times can make an investor very rich. Point number 1. Younger people should endeavor to study markets and invest in long-term enterprises which have the potential to outpace other companies and industries and stay with them as long as the theme is intact. Every few years we have a bear market that can scare investors away. Instead, investors shall stay the course and not miss out on the opportunity to buy stocks at low prices. Point number 2. Investors crave activity and it is hard to sit patiently on their stock holdings. Media plays an important role in attracting investors to buy and sell in a short span of time. This incurs additional charges that intelligent investors must avoid. Do not make your broker rich by trading often. Investors see shiny stocks zipping by them, and they can't stand it. So they chase whatever is moving and get into trouble. They enjoy stocks when they are moving up. People get bored holding the same stock for a long time, especially if it doesn't do much. This frustrates them and to press the sell button. Patience is very important to enjoy truly mammoth returns. Let me support my argument with an example. Apple from its IPO in 1980 through 2012 was a 225 bagger. But those who held on had to suffer through a peak-to-trough loss of 80% twice. The big move from 2008 came after a 60% drawdown. And there were several 40% drops. Many big winners suffered similar awful losses along the way. Point number 3. Relying only on published growth trends, profit margins and price-earnings ratios is not as important as understanding how a company could create value in the years ahead. Focus should be on the competitive strength of the company and its ability to create value for shareholders. For example, the ideal business during an inflationary time is one that can A. raises prices easily and B. doesn't require investment in a lot of assets. Point number 4. Don't sell just because the price moved up or down, or because you need to realize a capital gain to offset a loss. You should sell rarely, and only when it is clear you made an error. The BSE Sensex has a base of 100 for the 1979. The Sensex first touched 10,000 in February 2006. That's a 100 bagger in 27 years, or 19% annually. As I write, the Sensex is at 32,000. Point number 5. Looking for 100 baggers means you're not going to care much about what the Federal Reserve is doing. It means you're not going to buy a stock because you like the chart. Next month's chart might give us a whole different signal. Paying attention to these things is a distraction. Investing for a 100 baggers means you have to plant your feet firmly in the ground and stand still. Point number 6. Imagine if a friend had introduced you to Warren Buffett in 1972 and told you, "I've made a fortune investing with this Buffett guy over the past 10 years. You must invest with him." So you check out Warren Buffett and find that his investment vehicle, Berkshire Hathaway, had indeed been an outstanding performer, risking from about $8 in 1962 to $80 at the end of 1972. Impressed, you bought the stock at $80 on December 1972. 3 years later, on December 1975, it was $38. A 53% drop over a period in which the S&P 500 was down only 14%. You might have dumped it in disgust at that point and never spoken to that friend again. Yet over the next year it rose from $38 to $94. By December 1982 it was $7,765 and on its way to $223,615 today. A compounded annual return of 20.8% over the past 42 years. Point number 7. Investors have been conditioned to measure stock price performance based on quarterly or annual earnings but not on business performance. One memorable example is Pfizer, whose stock lost ground from 1946 to 1949 and again from 1951 to 1956. Performance-minded clients would have chewed the ears off an investment advisor who let them get caught with such a dog. But investors who held on from 1942 to 1972 made 141 times their money. Key is to stay the course. Point number 8. Do not base your judgment on economic forecast. Attempting to invest on the back of economic forecasts is an exercise in extreme folly, even in normal times. Economists are probably the one group who make astrologers look like professionals when it comes to telling the future. They have missed every recession in the last 4 decades. And it isn't just growth that economists can forecast, it's also inflation, bond yields, and pretty much everything else. Point number 9. Over the long run, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business here is 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally bought it at a huge discount. Conversely, if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive-looking price, you'll end up with a fine results. Checklist. 1. You must look for them. They are plenty, all you need is an open eye and find them. 2. Growth, growth and growth. 3. Lower multiples preferred. A low P/E stocks is preferred over a high P stocks with same growth rate. 4. Economic moats are unnecessary. For example, Coca-Cola. 5. Small companies preferred. When small companies become large, tremendous wealth can be created. 6. Owner-operators preferred. Promoters have high stake in business because they believe the business will do well in the future. 7. Stay the course. Do not get upset by daily market gyrations. 8. You need a really good filter. This is done to stay away from bad companies. 9. Luck helps. 10. Be a reluctant seller. Don't sell quick.